Hey everyone, my name's Andy. I'm from Finding Value Finance. I'll be your host today. We've got Akhil Patel with us. Thanks for coming on, Akhil. He is the author of The Secret Wealth Advantage book that he wrote, and he is the director of property share market economics. So if you want to learn more about him, definitely go check out his book and definitely go check out his website. And I think you have a YouTube channel as well, which is also under the property share market economic.
Yeah.
So thanks for coming on, Akhil. Appreciate it.
Thank you so much for having me.
I'm going to start off with just a broad question so people can kind of orient themselves of what we're going to talk about. So first, I wanted to start with what is the real estate cycle and why is it such an advantage to know about the real estate cycle in terms of investing?
Well, it's it's called the real estate cycle, sometimes called the property cycle in Europe. I actually call it the economic cycle. So it is a period of around 18 years, which encapsulates the main period of boom and bust that you get in our economies. And people who study their economic history will know that you get a major crisis every so often. And to really understand how these things build and develop, you need to understand the 18-year cycle. Now, if I can just sketch out how it works, just so that everyone's kind of on the same page, it's typically 18 years. It's rarely less than 16 years. It's rarely longer than 20. It's been going on in the US for over 200 years. And that 18-year period is itself kind of composed of around 14 years of expansion and 4 years of crisis and crash and recovery and so on. And that 14-year period of boom and expansion is typically two 7-year halves interrupted by a mid-cycle recession. So in each kind of 18-year period, you get a mid-cycle recession. Sorry, start again. In each 18-year period, you get a 7 years of expansion, you get a mid-cycle recession, you get another 7 years of expansion, typically stronger than the first 7 years. You get a peak in the cycle, and then you get 4 years of crisis, frankly, economic depression, but sometimes they're still called recessions, and things are very sluggish for a bit of time, and eventually they recover and they start the next 18-year period. This is ultimately the economic cycle. It's called the real estate cycle because it's driven by what's going on in the real estate market. Actually, it's really the land markets, but we tend to talk about real estate rather than land. And the reason why it's an advantage to know about is because, if you're an investor, you want to know when things are moving up, and you want to avoid holding assets or trying to sell assets when things are crashing down. And while individual asset classes and individual markets might have their own particular rhythms, uh, nothing really stays elevated during the crisis phase of the 18-year cycle. And so even if you're not interested in real estate, you need to know about it because it's the time in the cycle when banks are falling over, when currencies might be collapsing, when it's very difficult to obtain business loans, when there's a very high rise in unemployment, and when governments are really struggling to raise tax revenue, and so on. So they're very, very difficult periods of time. And regardless of whether or not you're a real estate investor, you need to know about those periods because they're definitely going to affect the asset class that you're interested in.
So what ultimately drives the real estate cycle? Is it demographics of populations increasing, decreasing? Is it the interaction between real estate and the demographic? What drives and kills these real estate bull market and bust markets?
Yeah, it's a really good question. So demographics, of course, push up demand for residential and commercial real estate. Um, but the reality is that even in a city that's not growing, certain locations are more favorable than others. And the expansion in business credit enables people to borrow more to acquire real estate in the best locations. And the best locations are where people want to live and where businesses want to set up. The reason why prices go up so much and don't come down again in the same way, unlike, say, other commodities, is because ultimately, while you have a almost infinite amount of land in the United States, you have a very relatively small number of locations that are actually valuable because that's where other people are located. And so it means that, you're talking about a monopoly asset in many ways that can push prices up. Everyone needs bank credit to acquire real estate, unless you're very, very cash rich. And therefore, the banking system is largely exposed to what is going on in the real estate market. And because these things are effectively, have a certain monopoly type characteristic, uh, prices can get pushed up really high. That generates its own sort of speculative frenzy, and it's unsustainable. And when it starts to come down, it can really affect the banking market, which then starves businesses of credit. And when businesses don't have credit, a lot of them have to close, they have to fire people. So you get a rise in unemployment and you get sort of the chain reaction that you see in very difficult economic times. And so ultimately, everything is tied to the real estate market because, also, real estate is probably the most valuable asset um, going because it's important to the banking system, because the valuation of a lot of companies themselves is predicated on, the real estate and other assets like real estate that they hold. Um, and so when it comes down, it affects the entire economy.
When we go through the real estate cycle or property cycle, does the entire world go through it simultaneously, or do certain areas and sectors like the United States, Europe, Australia, do they go through it at different time frames?
Yeah, this is a really interesting and very pertinent question. So I mentioned earlier that the cycle has been going on in the US since 1800 at least, and that's documented in the book that my business partner Phil Anderson wrote, The Secret Life of Real Estate and Banking. Um, Now, what's quite interesting is that the US real estate cycle starting in 1800s and kind of ending in 1818 and then starting again and ending in 1836 and so on. Um, it was on a different 18-year cycle to the United Kingdom. So in the 19th century, United Kingdom was the world's dominant economy and the main creditor and the British Empire and all that sort of thing. And the UK and the US had 18-year cycles, but different timings. What we've found since then, or since the end of the 19th century, is the US assumed economic leadership and became the world's largest economy and the world's most important kind of power and so on, creditor, at least after the Second World War, is that the cycle synchronized, in particular after 1955, when, reconstruction had completed in Europe and demobilization had happened. And you found that Western economies were pretty much on the same 18-year pattern. So we had a peak in the early 70s, we had a peak in the late 80s, and of course we had the peak in 2006, 2007. What you also tend to see is that the US is 6 to 12 months ahead of, say, the UK and parts of Europe and Australia and Japan. So it is increasingly synchronized. I suppose the question that will kind of that I'm really thinking about at the moment, and others will think about in years to come, is whether China exhibits. Firstly, does it exhibit an 18-year cycle? It's not a given. It's a very different type of economy to the US and the UK. And if it does exhibit an 18-year pattern, is it the same timing as the US? Now, these are still, to my mind, somewhat open questions. My starting hypothesis is that it does have a cycle and it does follow the same timing as the US, a little like Japan did after the Second World War. It was, totally, destroyed after 1945. It rebuilt itself. It grew very quickly. It had a very minor sort of dip in the 1970s when Western economies had, or say European and American economies had um, much more significant downturns. But very famously, it had a major, major real estate crisis in the early 90s. And in fact, it was so severe that it effectively taken them 20 years to sort themselves out. And so it did start to synchronize in the same way. Will the same thing happen with China? Hard to say. China at some point will be officially the world's largest economy. I mean, it probably already is. If you look at it in purchasing power parity terms, And so maybe what goes on in China will affect us to a greater degree than say with a Japan story. It remains to be seen. I mean, US, of course, is still a very, very, very large economy, um, and what happens in the US affects the rest of the world. So let's see. That important question.
When I look at China, it looks like their demographics has kind of fallen off a cliff of home buying ages, and we've seen them go through some turmoil here in terms of price declines in the real estate market. That's why I bring it up.
Yeah,
I'm going to bring up an image of the real estate cycle so everybody can see it. Um, this is the real estate cycle, the 18-year real estate cycle. We've got previous maybe recovery phases, mid-cycle wobbles, the big winner's curse phase at the end of these big moves, and then the hyper supply and recession. Um, I grabbed this from the internet. This may not be up to date. There's a 2024 somewhere between the mid-cycle wobble and the potential big winner's curse phase. Where do you think we're at in the cycle? Why do you think we're in this particular location? And what are you using to gauge where we're at?
yeah, all good questions. So I think this is kind of a replica of something I created back in 2016, I think it was, with the dates. So whoever's updated it is not they've made a slight, in my view, a slight error. But let me just to go back. So those of you who heard my description about the 18-year cycle, they can see visually now there's a sort of 7 years of expansion out of the start of the cycle. Then you get the mid-cycle slowdown or recession. Then you get another 7 years of expansion. And if you notice in that 7 years of expansion, which is the second half of the upward phase, um, you get an acceleration towards the peak. And you just mentioned the term, people call it the winner's curse. I call it in my book the mania. But this is where things are really, in terms of sensible investing, kind of going over the top, or sense is going out the window, or whatever the relevant metaphor is. And then you get the peak, and then you get the major kind of crisis at the end, which it takes 4 years to sort out. Um, so the mid-cycle slowdown did not end in 2022. I think that's the key point. They tend to be much shorter and more difficult, sorry, less difficult to get out of than the crisis at the end. I think what happened with the COVID situation is that the enormous stimulus that was put into place around the world basically ended the mid-cycle slowdown very quickly. So things were slowing down in 2019, and then COVID came along, and obviously disrupted things very significantly for a few months. Then we got this enormous stimulus and ultra low interest rates, and that kind of put some rocket fuel under the global economy for a couple of years, despite the fact that actually it couldn't handle that level of stimulus, given that supply chains and other things were so disrupted. Um, and that pushed us into the second half of the cycle. And so therefore, you're looking for a sort of a 6 to 7 year phase for the second half, which would, as correctly said, you look for a peak in 2026, and you're starting to see that things in certain markets are really, if the news was properly objective, you'd have to say a sort of starting to heat up in a way that we have not seen since the start of the current cycle, which was around 2011, 2012. Um, so I'd say that the yellow dot should be further along to the right. And so we are getting to the final couple of years of the present cycle. Sometimes these phases can last a bit longer. Um, Ultimately, the dates are related to what's going on in the land market. And so it sometimes means that other assets can have their peaks and troughs in different sort of kind of years. And I know we may talk about commodities in a few minutes, and we can talk about the commodities relationship with this cycle. But as a broad framework, I think this is the sort of the way to think about it, and I think we're further along than is depicted in this graph.
So I'm going to ask a lot of questions here, and kind of dive into the timing of where we're at. So
Yeah.
you said that we went through 2020, the COVID crash. The stimulus brought us out of that crash, et cetera, et cetera.
Yeah, it was the
Um,
shortest recession in US history. So, in March 2020, everyone's saying it's the worst thing since the Great Depression. And it was ended up being the shortest recession in American history.
so my question is, what makes you think we're right before the big move versus almost coming out of the mid-cycle wobble still? Could that stimulus distort the cycle to some extent, given that if I look at a lot of the metrics that I look at, and I'll share some graphs here,
Yeah.
and this is where I am trying to dive in.
Yeah, please. Yeah, yeah.
Commodities and a lot of these things that start going up during an expansion phase of real estate, they haven't really moved yet. They're still at these levels that are just incredibly low, like the commodity to equity ratio. We can look at currencies like the Canadian dollar versus the US dollar. And last cycles, we were in the mid cycle wobble in this region of the corner. And we're in the same kind of general location for mid cycle wobble this time, like the Canadian US dollar. You could use the British pound versus the US dollar. You could look at the Australian dollar versus the US dollar, and it's just starting to break out. There's other signs like big picture view, like the S&P 500 versus gold. We're just starting to break out to the downside of these. And this year was the early 70s. This year was, I'd say, early 2000s here when it started to turn, and now we're just starting it. Um, do you
Yeah.
still, I mean,
Yeah, yeah,
looking,
yeah. No,
looking,
this is good. These,
yeah,
I mean, these are very important. These are very important, very pertinent questions. So um, I've got quite a lot to say. Where should we begin? Maybe if you actually, do you mind bringing up the first chart that you showed?
the commodity to equity ratio.
Yeah, yeah. So
So
I
here we
think
go.
it's quite important. Now, I mean, the 18-year economic real estate cycle, whatever you want to call it, goes back a long time.
Mhm.
Um, it doesn't mean that every asset class behaves in relation to the cycle in the same way. What I said to you at the start was you really don't want to be holding risk assets during the end of the cycle phase, which means that you have to be very careful, and so it does give the veneer of appearance, sorry, the appearance of um, everything kind of crashes at the same time. So everything must move before that in the same way each cycle. There are other cycles at play, and you're a commodities man. You know that commodities move in 60-year cycles linked to the Kondratiev wave, or 55, 60 years. I look at a 30-year commodity cycle, and so on. And gold has a particular relationship um, to the real estate cycle as well. Um, so I mean, in relation to the commodities to equity ratio, for example, and no, ignoring the sort of absolute levels, because the absolute levels and price earning ratios in the current moment are just so incredibly high compared to previous cycles and so on. I think the absolute levels aren't particularly helpful by judging whether something is at the right level or not, or expensive and so on. You have to judge these things in the context of their times. But for example, the second half of the real estate cycle before the last one, so sort of 87 to 89, you notice that commodities were similarly quite low against the S&P or equities, and they did move up um, somewhat into the peak of the cycle in late sort of 88, 89. And then, of course, we had a spike because of what oil prices did because of the Gulf War. So there was a sort of a peculiar factor related to that. So the spikes actually tend to take place during the crash, not during the peak up to the peak of the cycle. And so you could well argue that we had the low in 2020, and things did not move up, particularly for commodities because there was a lot of hype in some commodities and, everyone started supplying it and then it collapsed because China didn't do the same kind of stimulus that the rest of the world did, et cetera, et cetera. So there are some maybe certain specific factors to now. Um, but you would expect, I mean, and this is where there is a repeating pattern. You would expect for the second half of the cycle that commodities do better relative to equities than they have done. And the reason for that is because there's a big construction boom and there's economic growth and so on. And there's demand for, copper and iron ore and, people like to kind of hold gold for whatever reason. There's some inflationary concerns going on and so on. And so you do get a rise in the ratio, but you don't necessarily get exactly the same kind of rise that we got between 2000 and 2008. And that was fueled by the fact that, commodities were at multi-decade lows in 2000. And then you had China joining the World Trade Organization in 2001. And then you had the China story that drove commodities for 7 or 8 years, and we certainly don't have the China story now, and nothing has come in place to supplant it, despite the fact that, people have this view that with the green transition, everyone needs copper, and with AI data centers, they need copper, and they might need sort of uranium to power nuclear fuel, which powers these data centers and so on. So it hasn't been the same story. Nonetheless, I do expect commodities to finish up at a higher level than they are now relative to equities as we go into the peak. It's just not going to be the same type of story that we got between 2000 and 2008. And I'd say the same thing with I think you looked at gold. Now, gold tends to, on the whole, in my view, follow commodities in general. Um, but at the end of the cycle, gold sells off because when the economy is collapsing, you've got to basically sell whatever you can, and that includes gold in order to repay lenders and meet margin calls and do all those other things. And then when people are really worried about the end of the financial system, which you do get in a financial crisis of the nature that you have, that we had it in 2008, that we had in some places, in particular in the early 90s. It's kind of the depths of the savings and loans crisis that we had also in the early to mid 70s. When you get those situations, then there is a flight into gold, and so gold goes up relative to the S&P, which itself is crashing down. So that's why you get the big moves from the peak of the cycle in 1972 to the low in 1978. And you didn't see it necessarily right at 2004. So part of the move into 2004 into 2007 was the China story, and gold had this massive bull run from really low levels. But the real kind of crisis point came just to the right of that circle, so just around the part of 2008, and then you saw a real in 2009 onwards. You saw 2008 in particular, but 2008 you saw the major collapse in equity markets that brought this ratio down, and then you saw this massive run in gold into the peak in 2011. Um, so you can discern the real estate cycle um, in these graphs, but you do, I think, need to understand you need to overlay the dynamics of the cycle, in my view. I mean, of course, you can say I'm just reading things as I wish to read them, but I think that's why sometimes you need to be a bit careful how these charts are put together and what conclusions are drawn from them.
So I've got some more questions and a couple more charts to show and ask questions about. If we're coming up into a winner's curse phase, or the big boom phase, shouldn't we be seeing home sales start to accelerate? Shouldn't we start to see the housing starts start to move up? If we look at
Yeah.
the United States housing starts, I'm just going to pull it up here. And this is just history of housing starts. This was the last big boom, and we had this kind of mid-cycle wobble that occurred. This was 99, and it ended, I think, 2001, and then we took off again. It looks eerily similar, the setup, to the mid-cycle wobble when I look at it myself. We are underbuilt by some people. Their estimates are somewhere around 4 or 5 million homes that were underbuilt. So my question is then, why are we seeing home sales slow? Why are we seeing housing starts decline? And how are we not in a mid-cycle wobble in relationship to the real estate market? Like that's where I get confused because a lot of people say that we're further along in the cycle. I'm still confused. I still almost think that we're in the mid-cycle wobble. And the way that I've been viewing this, and I really want your opinion, is is the mid-cycle wobble defined by financial stuff, or is it defined by housing starts? Is it defined by land values? What is it defined by, and how do we get a good? Is it by home sales? Like, because home sales have fallen, our inventories are coming up a little bit, and we're seeing our housing starts kind of decline from 2021. And that is the exact moment that interest rates from the Fed funds and interest rates shot
Yeah.
up during that time
Yeah.
frame. So how
Yeah.
how can I
Mm.
how can I think about this?
Yeah,
This
no,
is
I
where
mean
I'm
it's
getting confused.
yeah, no, I understand. I totally understand. I totally appreciate what you're saying. I think there are a couple of things to say in advance of that, and you kind of alluded to it in one of your questions earlier, which I probably didn't answer fully, and that was, has COVID stimulus and things thrown the cycle off? Now, my view is that if the cycle has been going on for 224 years in the US, and it's only been interrupted by the First and Second World Wars, it's going to take a bit more than even, very serious and kind of economy-wide pandemic to and response to it to throw things off. But nonetheless, it was a very significant episode in our lives, kind of professionally and personally, and also economically. Um, and I think we did something fairly unprecedented in economic history, which was to lock the economy, you know, at a time we were already starting to deglobalize, if that's the right word. We basically shut down the global economy in many ways. We disrupted all of the supply chains that have been built up over the prior 50 or 60 years. Um, we gave people record levels of money, which led to record levels of savings. And then we opened things up, having denied people sort of any kind of, you know, normal life for several months. And people, I think, went somewhat crazy. And I don't mean that in any sort of pejorative way. We just kind of there's a very much in my view, a mentality of, you only live once. You got to get out there. You got to go and see your friends. You got to spend money. You got all this money. Go and buy stuff. Go and have fun, etc. Um, all of that sort of demand and savings hit the economy at a time when supply was not able to adjust. A lot of business had closed down and made it through the mid-cycle recession and COVID kind of lockdowns. And, our economies are not nearly as competitive as they used to be in the sense that there's not as much competition. A lot of chains are owned effectively by the same company. And so that gave pricing power to businesses and they pushed up prices very significantly. They did not need a second invitation to do that. And people continue to spend. And it just pushed inflation through the roof. And the Federal Reserve, which initially said in 2020 and 2021 that this is a transitory phase, and I have some sympathy for that because it was this point that maybe supply chains will get back to where they were. Um, they then realized that this wasn't going to happen, and then we had the start of the Ukraine war, etc., etc. And frankly, they panicked and they put rates up from 0 to 5 in a very short space of time. Now, I think most economists who study the monetary transmission mechanism recognize that it takes a year to 18 months or 6 months to 18 months. I don't know what the exact number is for one interest rate rise to feed into the economy. So the idea that they can somehow manage the economy like this, I think, is sort of nonsense. I think they overdid it. Anyway, this is a very long-winded way of saying that yes, there were some one-off factors. One of those was this sort of crazy reaction to the inflation problem, which has a very, very significant effect on certain industries, and housing is one of them. And so we had a situation where probably land prices. So if you're a residential real estate developer, you've used up all the land in your land bank or whatever it is you've got, and so you've got to go out there and buy expensive land. Then there's this inflation thing. You've got to pay people higher wages because you can't get workers, and all the materials are going up because there's a bit of a boom in commodities. At least there was in 2021 and 22, and then your financing costs go up in 22 and 23, and so on. And mortgage rates are at 7%, so new buyers can't get onto the housing ladder. It's a problem, and it causes a deep slowdown in housing stocks. But does that define the mid-cycle recession? Not to my mind. If you look at what was going on to starts through the 80s, which was a real estate boom, housing starts were declining throughout that, if I'm not mistaken, throughout that period, or they certainly weren't going up as they did in the 2000s. Um, so so I think that there are certain. I mean, the point is that the real estate cycle is to a certain extent defined by the real estate market, but not every factor within it necessarily operates in the same way. Now, maybe you're right. Maybe there is a possibility that um, because of this enormous adjustment in in interest rates, and then everything kind of slowing down in the housing market at a point where it looked like things were really starting to move. Um, and maybe the expectations that were generated by China reopening were then, either derailed by what went on in Ukraine, or maybe because China is not going to do the same kind of economic policy that it did in the past. Maybe these are new factors. And maybe what it does mean is that the mid cycles, I don't think the mid cycle, I think the mid cycle slowdown is over in 2020. So I wouldn't say that, but maybe the boom hasn't really taken off as you would fully expect at this stage of the cycle, and maybe it might go on a bit longer. That is certainly a possibility that I'm entertaining, not least because we sort of got something like that in the 1920s, where we had, the First World War, we had the Spanish flu, things started to recover in 1922. And then, quite interestingly, in early 1925, the UK went back onto the gold standard to kind of support that process. The Federal Reserve cut interest rates in 1925, at the start of 1925, and it kind of created this almighty boom. Now, it wasn't very even though people talk about that as the Roaring Twenties and so on. The residential real estate market peaked in 1926. Um, and so you would say that is actually the peak of the cycle. Agricultural land was doing terribly since the recession of 1920, but you had a commercial real estate boom, and all these sort of, fantastic Art Deco buildings coming up in LA and New York and Chicago and places. And of course, because there's a lot of credit and a lot of speculation, and people felt like it was a new era and all that sort of thing, you had a massive, massive stock market boom into 1929. Um, could we get something similar? So we get a peak in 2026 in land, and but markets go up a bit longer, and then would confirm there's a housing starts burst up for a couple of years longer, or people start moving back into offices, or offices look very different and they're sort of booming up again. Quite possibly, there are certain variations. I think the point is, though, is that this gives you a framework within which to um, judge how to put the sort of economic data together, and gives you expectations, because ultimately the cycle has been repeating for well over 200 years.
Do you think 2026 is a line drawn in the sand where it's gonna definitely occur there, or do you think this could be pushed out more into the future based off of the imbalances that America has in the housing market being so great? We're If we're 4 or 5 million homes imbalanced, let's say family formations in relationship to how many homes we have, and it seems to me that the interest rates and the affordability have had an impact. That's where we're seeing the housing starts and the sales decline in the short term. Do you think it could be extended out, or do you think 2026 is more of a hard, line drawn in the
Yeah.
sand, and that's what's going to occur.
No, it's a good question. So I think so. I've always said 2026 is the peak, not the moment the crisis happens. The crisis can occur. I mean, it did in 2006 was really the last peak in the land cycle in the US. Some might argue even late 2005, but it was only 2006. But we didn't really get the major crisis until 2008. And we didn't get the peak in the stock market until late 2007. So these things do start, it takes a while to really build and come down. Um, so you might, and the housing market was still fairly decent, if I recall correctly, in late 2006 and 2007. So, people were still buying, you could still get credit and all the rest of it. And so I would expect that's kind of a normal process, and I'd expect that we would at least have something like that. Now, whether it could be pushed out beyond that, I think, I mean, maybe if I don't know, there's a lot of things that potentially could happen. The Federal Reserve could continue to cut rates, for the next couple of years and really want to push things up. I mean, and I know that it's probably not wise to get too political, but Donald Trump is a real estate man. Real estate people want very low interest rates. He's very sort of public about, wanting the Federal Reserve to do his bidding and all that kind of stuff. And he takes, stock markets going up as a sign, somehow a sign of how well he's doing. Um, and so, you could well have things, quote unquote, being pushed out into the future. And from an investment point of view, maybe it doesn't matter, but um, I'd say that behind the scenes, you might start to see one or two warning signs in line with the timing that I've outlined. But it's certainly a possibility. I think there was another point in your question that I wanted to come back to, but I've forgotten, so maybe it'll come back to me in a second.
Yeah, I don't know which point I'm trying to remember here, but I'll ask some more questions too. I've got a whole
Yeah,
bunch of
yeah, of course.
questions lined up. Um, when you talked about commodities and the interaction with real estate and all these things, the do you view commodities going up as a function of supply demand, or do you view it as a function of strength and weakness in the dollar? Because I showed some charts
Yeah,
of the Canadian dollar versus
yeah,
US dollar, and we've always seen these commodity bull markets.
yeah, yeah,
You see the commodity currencies outperform. So I'm just
yeah, yeah.
curious what your opinions are there.
Sorry, I could have mentioned some of this earlier. I do remember what I was gonna say. Should I go back to that or not?
Whichever one.
Yeah. Well, it's sort of related. So, you mentioned the imbalance between, household formation and
Yes.
availability of housing. I mean, this is an enduring part of the cycle. So there's somehow always a housing shortage before the peak of the cycle, and then suddenly after it, you've built too many houses or apartments and so on. So I sometimes read some of those things with a little bit of skepticism. Now, it's obviously true that you've got a lot of inward migration into the US. Everyone needs somewhere to live. And so you do need houses to be built. There's also an awful lot of housing that's held out of use. They're just empty, sitting there idle, and that's there are ways to incentivize people using that, but we don't have that kind of system in place, and that's certainly true in the UK as well. And the higher that housing prices go, the more you get this sort of things not being utilized properly. Um, Ironically enough. And so some of these projections of the imbalance, yes, it could power the cycle further, but it could also, Ireland had a housing shortage into 2007 supposedly, and then after 2007, it had enough housing being built for 3 years worth of supply. So you can sometimes these things can reverse quite quickly. All right, so gold, so commodities and so on. I mean, I think it's both a function of um, demand, and it's also a function of, at least in the second half of the cycle, of the US dollar falling. Um, I mean, my understanding of commodity markets, and you're probably more of an expert than I am in this, is that they are very finely tuned to kind of fluctuations in supply and demand. Um, and probably out of the COVID thing, when commodities went very significantly higher, there was a lot of supply that was invested in that is coming on stream. And I think some of it was predicated on China doing these massive kind of infrastructure related stimulus um, packages that happened in Europe and the US, and China decided not to go down that route. And China is, the commodities story. Let's be honest. I mean, it's insatiable demand for raw materials, and even though it still has that, it's not quite the same extent that people. I'd say it doesn't grow in quite the same way um, that it did in the 2000s. And I think that has been one of the factors that has pushed in some commodities push prices down since 2022. The other factor, of course, is the US dollar, and the US dollar side of things is somewhat related to interest rates and somewhat related to geopolitical turbulence and so on. And so the US dollar has been, I suppose, unusually strong in the second half of the cycle relative to other currencies. It has come down. It's tested its 100 level, the Dixie's 100 level. It's kind of pushed up again because of the possibility of a war between Israel and therefore the United States and Iran. I think actually my expectation is it will fall into the peak of the cycle um, because I think US monetary conditions will ease. Federal Reserve may cut short-term rates, and so I expect that will push the dollar down. That will, of course, be good for those commodities that are priced in US dollars. I suppose we ought to point out though that unlike the last cycle, the US is now the world's largest oil producer and is exporting quite a lot of energy, and that does increase demand for dollars. And so maybe it won't go down to the same extent or quite the same way that it did in the last cycle. We also live in a period of geopolitical turbulence, more so than the last cycle, and that's related to a longer term cycle that you know about and that I study as well, called the Kondratiev wave. And so when you get periods of turbulence, there is a flight to quality. People still think that the US dollar is the asset to hold in such periods, and so maybe it won't quite move down in the same way that we saw in the last cycle. But I do feel overall it will fall, and at some point, if it falls far enough, you'll get a lot of stories about the end of the dollar, um, and that will maybe cause a bit of a panic, and that will really throw things into to kind of real sort of. There'll be a lot of noise around that. And it'll all be about China and other countries taking over and et cetera, et cetera. And that will, I think, throw markets into turmoil in a way that you'd expect at the end of the cycle.
When we enter these expansionary phases of real estate and we build all these homes, usually what we see the S&P 500 kind of track sideways during these commodity bull markets and or expansionary phases of real estate. At least that's what I've noticed in history. The chart looks like this, just so we're on the same page. So it's these sideways actions there. And do you think we're going to get something like that in the future where the S&P 500 tracks sideways during a potential commodity bull market if we're entering one here? What's your opinions around that, or even if you have an opinion? This one was the
Yeah.
crash, but they revalued
Was
gold.
there, well, the commodity bull, and we can take them. I think the first one is the triangle. It goes to about 19. Oh, yeah, got the dates, 1950. Yeah, I don't. I mean, I
This
think
one
some of
wasn't a
that
real.
commodity,
This one wasn't a real
some
estate bull market, so I don't
no,
want
no, some of
to
that,
like.
some of that's
Yeah.
affected by the World War, which munitions and other things, they're very commodity hungry in oil and other things. So I think the commodity bull market was somewhat affected by war conditions, but nonetheless, it really took off. In my view, um, it really took off in the 1960s. So the second one, the first one, I don't have a particular view on because I think it's very much war affected. And yes, we'd had the 1929 crash. It took sort of basically 20 years for the S&P to get back to where it was, and it's not going to go up much during during a war situation when everything is about fighting a war. And that was a period when the real estate cycle was interrupted. It kind of started again in the mid 50s. So I'd say the first one isn't particularly a case of the point you're making. The second one certainly is. And so the bull market lasted until 1966 or 1967. Um, it had another go. The peak of the cycle was around 1972, but there was a lot of messing around with interest rates and a lot of inflationary worries and very strange policies and a lot of things like the Vietnam War, which made the S&P in particular very turbulent for that period. And then you had the major crisis and you had the major fall in equity prices into the between 1972, early 73, and then the generational low in 1974, at a time when, because of inflation and other things, commodities were doing well, particularly oil, which itself was a function of the oil shocks in the 1970s, and gold, which, as I think said a bit earlier, at the end of the cycle, there's a fall in gold and then it goes through the roof because people are worried about the health of the financial system. So that is kind of a pattern that is consistent with the end of the cycle. Now, the most recent one that you've got there, so you had the mid-cycle peak in 2000, then things came down to 2002. Then you had I think from an equity investor point of view, it wasn't really so much that it went sideways. It went up pretty significantly in the 2000s to the peak in 2007. Of course, it looked sideways on that because it then came back down again because you had the end of the real estate crisis. Um, Commodities tend to peak after the equity market in relation to the real estate cycle. So I sort of look back over 200 years, and every time you get an equities peak at the end of the real estate cycle, and I think all but one cycles, the commodities peak is just afterwards. Um, and so you had commodities going up into 2008 when markets were coming down. They came down as 2009. Um, what you got in 2009 is well, late 2008, you got a $500 billion stimulus package in China. And when President Obama was elected in 2008 and was inaugurated in 2009, you got something similar in the US. And it's those two stimulus packages which effectively brought the global economy out of the last cycle. If we hadn't had either of those things, we'd have had much more significant economic depression. And what that did, though, was to push up the demand for commodities. So, Australia, for example, barely experienced a recession in 2009 because of the strength of what was going on in the US and in China. And of course, commodity prices appreciated along that until around 2011. So I mean, these do fit into the real estate cycle. Um, I don't know if we'll, I don't know what kind of pattern we'd see later this decade. Um, I think commodity prices will increase into the peak of the cycle. Maybe particularly now that China has sort of indicated its willingness to do some kind of stimulus, though some people are saying it's not enough, etc., etc. But it seems to have a different policy stance to what it had in the last 2 to 3 years. Um, I think so. If you're just in the period from uh, 2003 to 2007, um, you're actually seeing both commodities and stocks doing well simultaneously. And equity investors in that period were very happy with their equity investment. So it didn't really feel at the time like it was going sideways. And I think we'll have the same kind of feeling over the next 2 to 3 years.
And I would agree. And then another, I mean, just to show another chart too, I pulled this up. This is a home builder stock, so it's a kind of a swing producer. The last bull market was this here, and you can see that we are basically very well positioned again. And that also aligns really close with 2002.
Mm.
And all this data I look at is telling me that we are located in the year 2002 or one or something like that. So that's kind of just weird because the currencies align, like Canadian dollar and all this stuff.
Yeah.
Uh, they're
Look,
all, yeah.
it's a possibility. I think the dollar, the Canadian dollar and Australian dollar, um, they of course are probably more of the commodity story. And I've maybe suggested a way to look at that commodity story, uh, maybe with a slight variation to what you were saying earlier. Um, yeah, that home builder. I mean, I'm not sure that we'll get sort of a 4 year run in home building stocks in the same way that we will now. But I'm open to the possibility that things will go on a bit longer than a kind of a strict 18-year reading of the cycle um, suggests. Some home builders just may not get to the levels in terms of stock price that they did last time. I mean, no, I know that the demographic story and so on are very strong, but then, the cost of land and the cost of finance, the cost of labor, cost of inputs are also different, and that affects the earnings of such companies. And so maybe it doesn't have quite the same play as it did last time. And so that might then, adjust your view of where things are. But I think we now have two things to watch out for. I think we're sort of aligned in terms of how we see things playing out, and maybe the question is just one of where we are in terms of timing. And ultimately, I think I don't know if you trade or not, but we're both investors, and we know that our forecasts are our forecasts, but you only buy and sell and you're a technical person just like I am. We buy and sell in accordance to what the market's doing, not what we think the market should be doing.
And you're completely right there. um, Another question. Back in the 70s, back in some of these cycles, it was monetary driven. It was driven by bank lending, credit expansion, the housing market interacting with the demographics and a large demographic coming into home buying years. What we've got today is we have a lot of fiscal spending in this as well. I do have a chart just to kind of show you guys what it looks like historically, and I don't know if you've seen this chart. The the orange portion of it, consider that fiscal
Mhm.
deficit spending, fiscal spending, and then the blue is your money multiplier, or think of it as monetary bank lending expansion. And then when we look on the right hand side, and when we look where interest rates, like the 10-year coming down and falling for 40 years and then starting to break that downtrend for interest rates, we also have another kind of fiscal cycle that's overlaid on top of this. Is is this going to impact the real estate market, or is this going to be a bigger driver potentially of inflation? I don't know if you follow the fiscal side as much as the monetary. So,
Yeah,
what are your thoughts? What's going on here?
I mean, I mean, the fiscal side of things is endemic to the cycle because government spending on infrastructure is essentially what drives up land values because it makes the economy more efficient if it's done well, which often is, not always. Um, and it makes I talked about good locations being relatively scarce relative to the amount of land that's available in the US or in any other country, even a small island like the UK. Um, and it's often public expenditure on roads and bridges and parks and other things that make those locations desirable. And so fiscal is always a part of the cycle. Um, and so when governments are kind of in full-on stimulus mode, either at the beginning of the cycle, it pushes the economy into the new cycle that gets things moving again, or it might be pushing things up and over uh, at the end of the cycle. And I think, my view is that we people couldn't understand why we weren't going to get a recession in, 20 at the start of 2023 or in 2022. And people were absolutely certain that 2023 would see a recession, and we didn't get it. And one of the reasons was, and despite the fact that interest rates went from 0 to 5, and one of the reasons is because of where we were in the cycle, and one of the factors of where we were in the cycle is this enormous stimulus that's going on. Workers having higher wages, and therefore, while we've talked about this kind of slowdown in the housing market in terms of building and so on, and lower turnover, people paying more in rents and so on, and being able to afford to, et cetera, et cetera. So, I mean, these were some of the factors why we, didn't get a recession. And so the fiscal side is important, and the greater the amount of kind of government spending, and it looks like whoever wins next week's election, it's not next week, the week after's election, is going to continue that, maybe in different ways, but it will continue. And you would expect that to drive things to the peak later this decade, and we've seen it in previous cycles as well. On top of that is also the bank credit creation side of things. Um, and one of the things that the high interest rates have done over the last 2 to 3 years is put $1 trillion into the net income of US banks. So it's been incredibly lucrative. Now, they've got a lot of firepower to lend into the economy um, to make sort of further profits. So you'd expect that to play a part. And actually, the biggest story in terms of, people always talk about government money printing, but really the biggest story in terms of money printing is what the banking system does. And the banking system is the main printer of money in an economy. And so we'll see both of those factors at play over the next 2 to 3 years.
One last question here. When we come towards the end of this cycle, what are some things that you're looking at to hit the exits? What are some I don't know, leading indicators that you're looking at to say this thing is done? Is it inventory levels? Is it housing starts falling below the average and coming out of that expansion phase? What are some things that you're looking for where this thing's gonna roll on over?
Yeah, I sort of detail some of those in my book, and just I mean, it's not a sales pitch or anything. I just think it's I put a lot of work into trying to help people sort of navigate their way through each phase of the cycle. And so my book is structured as a journey through a cycle, and I illustrate each phase with a different historical episode, and then I pull out things that people should look out for, and also what they can do about it, or what they can think about in terms of their own investments, sort of phase by phase for each phase of the cycle. So the things that I tell people to look out for prior to the peak of the current cycle is some of the usual things that you might expect with an economic boom. So a lot of euphoric, slightly crazy, unhinged behavior by celebrities and even by regular people in terms of their spending. You see a lot of extravagance. You see uber tall buildings popping up all over the place. I noticed that, one of the, if not the tallest building in the US is currently being built in Oklahoma City, of all places, which I find quite incredible. But it's often in smaller cities that you haven't necessarily thought would be capable of building something like that these things end up in. Um, you you might want to talk a little bit about the yield curve. You tend to get an inversion of the yield curve. You tend to have everyone talking about investing in whatever the asset of the day is. Um, you have, your bank manager calling you up to lend you money because they want to make money on lending to you, et cetera, et cetera. Um, you find though that actually things become quite tight for consumers. So not necessarily because energy prices are high and so on, but you're in a boom, but people are being squeezed between high rents or high mortgage payments, and wages not going up quite as much as they did before, and they maybe slightly cut back some spending. So amidst all of this, you might get some of these little signs. Um, markets by definition almost are all-time highs across the board around the world, etc. US dollar is falling, as I've said. We've talked about that. Commodities are doing well. And then one of the great sort of warning signs is when the broader stock market is going up, but housing stocks, home building stocks have peaked and are starting to fall. And that is because they are pricing in lower prices for their product to come, or well, actually not, they're not pricing that in. Then what they're pricing in is not the same level of growth as they've seen over the past few years. And so that obviously then means that those stocks are sold and money's rotated into other areas. And so the broader market will continue to go up. People are still wanting to invest in stocks, but they won't be doing it in the housing sector. And that's
Yeah,
usually quite a good advance warning sign.
they peaked in 05, 06. They put in a Head and Shoulders top and
That sort of
started
thing.
heading
Yeah,
lower.
yeah, they do
Yeah.
exactly. I mean, it was a very, I mean, last time it was a very tall neck, so it came down quite significantly before. Um, in terms of what you can do, I mean, this really just depends on what you're interested in, what you know. I'm not the sort of person who believes that you should sell your entire real estate portfolio prior to the peak. I mean, you should take the opportunity to get rid of the things that aren't quite so good, maybe. Um, you should make sure that if you do have any sort of mortgages or borrowings, that you would be able to service them despite the fact that some of the income might be going down. So there's a bit of a margin of safety. You would make sure that you aren't reliant on refinancing at a potentially very difficult time for banks. So you're protected in that way. Um, you might want to have your money in certain safe things, government bonds. Um, Now there might be some kind of variations to that story, but government bonds, um, you know, diversify through sort of things like precious metals, and so on. I think you want to have as much liquid assets as possible because, the other side of a crisis is that you can find really good bargains. Um, and yeah, I mean, those are the things. It's you've got to. I mean, if you have a massive amount of money, a massive portfolio, you're going to struggle to, you can't obviously have it all in cash, so you're going to have to put it into something. So I'd sort of focus on those sorts of asset classes. I'd get rid of collectibles, um, or make sure that you're not wanting to sell them anytime soon. Make sure that those sorts of things are very well protected. Make sure that if you are in risk assets, that you are hedging, um, and look at the possibility of being able to short the market if you can.
And there is another question that popped up. You brought up the yield curve. We
Yeah,
do have the yield curve kind of uninverting at this time. What are
yeah,
your thoughts around that and what's going on there?
yeah. I mean, so normally in a period when governments aren't intervening quite so heavily in the bond market, you would find an inversion of the yield curve prior to the peak of the cycle. Um, but not right at the peak. It's an inversion, then it uninverts, things continue to go up, and then you get a sort of crisis. And the time between that inversion and then that uninversion and the sort of onset of recession does vary from cycle to cycle. We've obviously had a very extended inversion, and now it's going back into normal situation. And at some point in the future, we will get a recession. And so, in a sense, that indicator will work, but it won't necessarily work quite in the same way. I think the realistic thing to say is that the Federal Reserve is, massively intervened in the bond markets in a way that we haven't seen probably ever or since the Second World War or something, and they caused this massive inversion. Um, I think probably for me, the more interesting story is if it inverts again for a very brief moment in time. And a lot of people say, well, that's no longer an indicator of any value because, we had one last time and nothing happened. That for me would be a almost perfect setup because, you know, you want people to be looking in the wrong direction because that's what happens at the peak.
So you think we inverted, it'll come back down and then maybe come back up again and then uninvert later on in the future? You think that's a possibility,
That's a
basically?
possibility. Yeah. Yeah. So I
Yeah.
don't think I'm not sure they've quote unquote got inflation under control. I mean, I think inflation was coming down anyway, in my view. I don't think what they've done has had anything to do with it. It's obviously helped to kill off businesses and other things. But, people have to be seen to be doing something, however harebrained it might be at the time. Um, I don't, look, we're not in an era of 1970s style inflation. We never were, despite, 12% and so on for a brief moment in 2022. We're not in that era. And, um, there's just so many things that are causing deflationary pressures around the world. Technology being one of the main ones, actually, in addition to maybe some demographics. Um, so I feel that interest rates can remain fairly low, so we can get back down to low levels. It won't ever get back. hopefully to zero, because that creates problems of its own. But I think you will still see inflation sort of not doing what they think it's supposed to do, given that, they think they control the economy. And that might itself cause a bit of an inversion again if they start raising short-term rates at some point. But at the moment, I think rates will be coming down for a bit of time.
Okay. And when they lower those rates, we usually see a slowdown, but no slowdown since where we're at in the cycle is kind of what your
Yeah,
thinking
I
is.
think I think they basically got away with doing what, if you'd told all of us in 2020 that, this is all gonna end in tears, it's gonna be 5% in a couple of years' time. And not only that, it's gonna be 5% within the space of about 6 months or whatever it was. We would have thought, well, that is really gonna tank the economy. And it didn't, and that was because of where we were in the cycle and all these other factors that were going on. And we could just about absorb it. Um, and it wasn't maybe at that level for a huge amount of time. Um, but we have got used to it. We are not used to having interest rates. 5% in the last cycle was considered to be relatively low because of where everyone who was, an investor in the early 80s. Now, I wasn't, but I have read economic history. Um, it was more normal to think of interest rates in the double digits. And so 5% seemed really quite nice, or 4% or 3%. And now it seems like a massive pain, and too high, and it's far too painful to handle. And so things will, I think, come down, but they might not stay there for very long if inflation starts to tick up again, as you would expect when you've got a booming kind of real estate and commodities markets and other things.
So when the rates come down, we should be watching home sales, housing starts, stuff like that, and watch it start to come back up. Is that kind of what you're looking at?
Yeah, though I don't, again, as I've said, I don't think rates coming down has as much effect on those things as people think. It, of course, has an effect on the stock market, not least because it brings the rate on margin loans down, and so people can, add to their speculative positions and so on. Um, I think we're already seeing an increase in some of those data. I think it will be, of course, it will be boosted by the fact that mortgage rates should come down, and therefore it will increase demand. And if housing sales haven't really picked up quite as much, then that's quite good for prices and so on, and that will induce further building and so on. And that might cause lenders to reduce their margin so that they can get more business, and all those sorts of things that I try to detail in my book and that we've seen in previous cycles. So but it's not necessarily because interest rates have come down that is the thing that's driving it. I think the picture is a bit more complicated than that, but they tend to coincide with each other enough that people feel it's a causative a factor.
Anything else you'd like to share about the topics of discussion we've got today? Anything else?
Um, no, I think we've covered quite a lot of ground. I'd be interested to know what feedback your viewers and your listeners have about this, what sort of questions they have, and whether they find it convincing or not. But I think we've run through quite a bit of material.
I mean, if people want to follow your work, um, where do they go? What's your book? Go ahead and send it here so everybody can follow you.
I'm happy to share links, but my book is called The Secret Wealth Advantage, and it details the 18-year cycle, and it breaks it down into phases, and it tells you what to look out for each stage and what to do about it. So it's both hopefully educational, but also of practical use as well. If they want to follow my work and the work of Phil Anderson and other colleagues at Property Share Markets Economics, the web address is www.propertysharemarket, that's all one word, economics.com. And you can sign up for our free newsletter, which gives you a weekly update on what we're seeing in the cycle, and why it's relevant and how it fits in, which I think is useful read and keeps you in touch with that. And of course, there are sort of membership levels as well if you want to build your knowledge in a more detailed way.
And we'll put that in the description link below. All right. Thank you, Akhil, for coming on. I really appreciate it. Thank you for your time. And yeah, we'll see you next time.
Thank you for having me.